Welcome to this explainer on IGCSE Accounting 0452. Today, we're unpacking an absolutely massive topic: ratios, liquidity, and efficiency. Speaking as both your subject specialist and your examiner today, I can tell you this isn't just about recording numbers on a ledger. We are going to look at how basic data entry transforms into high-level financial intelligence and decode the exact strategies you need to secure that A star. Okay, let's dive right into our roadmap. We'll start with the A-star accounting mindset, move into mastering your technical execution, tackle AO3 to analyze the why, open up the examiner playbook for some insider secrets, and wrap it all up with a pause and think challenge. Section 1, the A-star accounting mindset. Let's look at these strict architectural requirements for the 2026 syllabus. It's actually fascinating how a simple vocabulary shift can completely dictate your final grade. For the 2026 syllabus, Cambridge has fully transitioned to modern terminology. If you write bad debts on your exam paper, you're literally living in the past. The mandatory phrasing is now irrecoverable debts, and instead of capital, we need to see owner's equity. Precision in your language proves to the examiner that you are a highly trained modern accounting student. Alongside that modern vocabulary, we have the prudence concept. Think of this as the ultimate reality check for any business. It dictates that you must never, ever overstate your profits, and you absolutely must recognize all potential losses immediately. Never violate this concept by ignoring risks, because banks, owners, and tax authorities rely entirely on this integrity. Honestly, it's way better to brace for a storm that never comes than to pretend the sky is clear when it's pouring. And supporting that core integrity are these principles. The accounting equation, assets equal liabilities plus equity, has to be maintained at all times. You apply the business entity concept, which means treating the owner and the business as totally separate entities. You ensure duality, meaning every single transaction has an equal and opposite financial reaction. And you adhere strictly to the historical cost principle. These aren't just bullet points to memorize, they are the architectural structure of your accounts. Perfect balance is simply non-negotiable. Moving on to Section 2, Mastering Technical Execution. This is where we secure those absolutely crucial method marks. So the trick here is making your logical flow completely visible to the examiner through these exact sequential steps. First, identify the correct source document, like an invoice or a bank statement. Then, translate that data into the books of prime entry. Next, take it to the T accounts, which is the absolute gold standard of double entry bookkeeping, and carefully balance them, making sure you clearly distinguish between your balance brought down and balance carried down. Finally, seamlessly transfer this to your trial balance. You've got to follow this procedural logic flawlessly. Now, let's talk about method marks, because this is literally an exam lifesaver. Method marks are awarded for your visible logical workings, even if your final mathematical balance is entirely wrong. This is exactly where you salvage points when the pressure is on. Show every single calculation for depreciation. Show every step of your inventory adjustments, because to the examiner, your investigative process matters just as much as getting the right number at the end. Don't do the math in your head. Put it on the paper. Lean in closely for this one. These are the specific mathematical traps that will derail your trial balance if you aren't paying strict attention. Miscalculating trade versus cash discounts? Classic error. In manufacturing accounts, forgetting your vital state symbols is an incredibly easy way to bleed marks. And of course, muddling your brought down and carried down balances in your T accounts. Stay highly vigilant here to guarantee your accuracy before you even touch the final financial statements. Section 3, AO3, Analyzing the Why. This is where we level up from basic calculation to A-star evaluation. Picture this scenario. You're looking at a business, confidently evaluating their liquidity, and suddenly their current ratio violently drops from a healthy 2.5 to 1 down to a highly concerning 1.1 to 1. Now, calculating that the ratio dropped is just a baseline skill. A basic software program can do that. But answering why this liquidity crisis occurred and what it practically means for the survival of the business, that is what defines an A-star response. You really have to put on your detective hat and investigate the underlying operations. And this brilliantly illustrates the cause-effect chain you must debate. If liquidity drops, ask the big questions. Are we hoarding inventory that we simply cannot sell? Think about the storage costs and obsolescence risks. What about our suppliers? Are we lagging on settling our trade payables, damaging those critical relationships? Or maybe our cash reserves are completely depleted because we aggressively spent on capital expenditure, like brand new machinery. You have to connect that sterile ratio on the page to the living, breathing, physical reality of the business. You also need to be incredibly careful with inter-firm comparisons. Imagine comparing firm A using the straight-line depreciation method with firm B using the reducing balance method. Firm A will show a nice, steady drop in asset value, while firm B's expenses are going to be heavily front-loaded in those early years. Differing accounting policies like these make direct, surface-level comparisons super dangerous. You simply can't compare apples to oranges and expect a meaningful financial evaluation. Always contextualize the numbers based on the policies each firm selected. Furthermore, you've got to look beyond the ledger to the true quality of profit. You must factor in non-financial elements that dictate long-term sustainability. I'm talking about things like staff morale, the physical location of the business, and its overall market reputation. You won't find a line item for employee happiness in a T account, but these factors absolutely dictate your return on capital employed, or ROCE, over the long haul. A highly profitable company with terrible staff morale is just a ticking time bomb. Eventually, high turnover is going to destroy those margins. Section 4, the Examiner Playbook. Let's look at some direct insider secrets pulled from recent principal examiner reports. I want you to treat this warning like gold. The report literally states that students frequently lose marks simply through poor handwriting in ledger accounts and the fatal failure to distinguish between revenue and capital items. Guys, if the examiner cannot read your balance brought down, you get 0 marks. It's really that simple. And confusing a day-to-day revenue expense with a long-term capital expenditure, that will instantly cost you your top grade because it fundamentally breaks the final financial statements. And hey, remember, these aren't just exam theories. Think about modern industry applications. AI-driven accounting platforms like Xero, used by millions of businesses globally, rely entirely on the exact standardized concepts you're learning right now. This software automates complex ratios, sure, but the underlying logic, the duality, the prudence, the precise categorization of capital versus revenue, is exactly what you are mastering today. You aren't just passing an exam here, you are literally learning the language of modern fintech. Now, if you ever freeze up under exam pressure when asked to evaluate why a liquidity ratio is dropping, I want you to use this memory hack. Just remember the acronym ISC. I for inventory overpurchase, S for slow payables, and C for capital expenditure. Just recall ISC to immediately trigger your cause and effect analysis and get that pen moving again. Finally, Section 5, the Pause and Think Challenge, the ultimate test of your financial intelligence. All right, here is your challenge. If a competitor shows a higher return on capital employed on paper, but you know they use a completely different depreciation method than you do, and they are currently facing a sudden, massive drop in staff morale, how do you evaluate their true long-term profitability? I want you to pause and really think about this trick question. Combine the mathematical limits of interfirm comparison with the vital reality of non-financial factors. Apply everything we've covered today. And until next time, keep analyzing the why behind the numbers.